Hello, this is Brandon Christy with Christy Capital Management and a July educational economic update on Britain's recent vote to exit the European Union and last week's positive U.S. jobs report. Please stay tuned at the end for a required disclosure statement. We're going to answer 5 main questions about the Brexit. What is the Brexit and why does it matter? Number 2, how could the Brexit affect U.S. markets? Number 3, what impact could the Brexit have on the global economy? And then how could the Brexit affect the U.S. economy? And what should investors do right now? So let's start by taking a step back and asking, how did Britain get here? To answer that, we have to go back in time and take a look at some history of Britain and the European Union. Britain originally voted to join the European Economic Community in 1973, and in 1975, Britons voted to join with the new European Community, which then became the modern European Union in 1991. Economic and political circumstances have changed drastically since the 90s, and British citizens demanded a new national referendum on EU membership. The issues at stake were complex and involved British sovereignty, trade, regulations, and immigration policy. Well, now let's talk about the effect the Brexit is having on markets. The vote to leave surprised investors around the world who reacted by selling. This is not an unexpected result because markets hate surprises. History tells us that recent market movements are probably an overreaction in response to the fear and uncertainty. If we look back, we see that since World War II, when there have been political shocks like this, the markets tend to oversell and then rebound in the weeks and months that follow. Will that happen this year? Well, there's no way to know. We should expect a lot of volatility going forward and a lot of headline risk. Headline risk is what we call it when markets overreact to media coverage of events. We can also think of it as the Chicken Little syndrome. We'll talk more about what investors can do at the end of this video. Now let's talk about the political economic impacts of the Brexit on the global economy. In Britain and Europe, a lot of the risks are political in nature. In Britain, it's possible that this vote will splinter the United Kingdom. Northern Ireland and Scotland both voted to remain within the EU, and they may vote to leave Britain in order to rejoin the EU. Exit negotiations are also likely to drag on for months and possibly years and be the source for a lot of political footballs. We can expect plenty of volatility in financial markets as those negotiations are hammered out. Economists also worry that Britain could lose a lot of multinational corporations who rely on access to European markets and the free movement of European talent. London is the center of Europe's financial world, and a loss of those financial firms would be a major blow to the British economy. The fallout from the Brexit could be enough to push Britain into a recession. One of the big worries that experts have is that Britain's vote will be the first of many anti-EU votes that could cause a rush to the exits by other EU member countries. Britain leaving is complicated enough. If a member of the Euro currency union like Netherlands or Greece left, negotiations would be even more complex. Well, no one knows what the breakup of the EU would look like, but it wouldn't be good for economic global growth. I also want to point out that many economists are a lot more upbeat. They believe that the more apocalyptic scenarios are unlikely to play out. Since Britain and Europe need each other, future negotiations are likely to be favorable to both sides. European leaders are also a lot more likely to make needed reforms to keep their citizens happy and avoid Britain's fate. How will the Brexit affect the U.S. economy? Well, that really depends on how the divorce is negotiated. Again, there's no consensus among economists. Here's what we do know. Trade with Britain accounts for just 0.31% of U.S. gross domestic product, or GDP. So British problems with trade won't necessarily affect us. We don't foresee any structural changes to the U.S. economy as a result of the Brexit. The dollar is often viewed as a safe haven in times of international turmoil, which is pushing the dollar's value up versus other currencies. A stronger dollar may weaken demand for U.S. exports, which may drag down economic growth. We should keep in mind the fact that the U.S. is a consumer-driven economy and that wages, the housing market, and improvements in personal finances all support consumer spending right now. Will the Brexit be enough to push the U.S. into a recession? That's not really likely, though it could contribute to weak growth in the next couple of years. Britain's vote will likely affect Federal Reserve policies this year. Post-Brexit expectations of a rate increase this year have gone down tremendously. Where predictions of a September rate hike were at 30% before the vote, they now stand at 0%. In fact, some experts even suggest that rates may be back on the table to be cut if economic growth slows. Well, in other news, U.S. markets surged last week after a surprising June jobs report buoyed investor sentiment. After disappointing April and May jobs reports introduced worries of a labor market slowdown, the June report showed the economy added 287,000 new jobs just last month. Since expectations called for around 165,000 jobs, investors counted the report as a solid win for the economy. Digging a little deeper into the June numbers gives us more positive news. The unemployment rate rose to 4.9%, which is actually a good thing because it rose as a result of more job seekers entering the labor pool. The Federal Reserve estimates that long-run unemployment in a healthy economy should average between 4.7 and 5.0. Even better, average hourly earnings rose 2.6% over June 2015, indicating that the labor market is tightening and employers are raising wages to compensate. Since economists have been worrying about the stagnant price of wage growth, the June data is encouraging. After June's strong job report, investors are feeling pretty good about the U.S. economy. However, it's important not to let your perspective be swayed too much by a single data point. While a healthy labor market supports continued economic growth and market upside, we expect additional volatility in the weeks to come. We still face a turbulent presidential election, corporate earnings season, Britain's EU exit, and other market headwinds. Enjoy the rally, but stay focused on your long-term goals. We would also like to mention that we have a special downloadable letter, the 5 Brexit Takeaways for U.S. Investors, for you to keep and to share with your loved ones. If you or someone you know would like to receive a copy, please visit our website at www.christycapital.com. Well, that's it for this month's video update. As always, if you have any questions or concerns about what we've discussed, please give our office a call at the number below. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 866-331-7749. This is Brandon Christy with Christy Capital Management and your July Economic Update.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision.